Hello, friends. Very good afternoon. My name is Raj, and today we are going to discuss about the basic accounting equation, wherein we are discussing as to assets are equal to liabilities plus equity. So that's the basic accounting equation which we are going to discuss today in our first video. And this is the most basic thing where all of us have to be very perfect because this is the foundation of accounting. So as you understand, assets are those which the business owns, liabilities are those which the business owes to the third parties, and equity is what is remaining in the business after the liabilities are paid off from the assets that are sold when the business gets liquidated. That is what is left over. So basically, we start a business, the equity or the owner contributes, let us say $10, and the $10 cash is received by the business. Here, we have to understand that the business entity concept in the accounting principle, the business entity concept is where the business entity is distinct from that of the owner. So we cannot mix both the incomes or the cash from the business with that of the cash that the owner has. So we separate the owner from the business. So business entity as such is different from the owner. That's why you might have this understanding as to why equity is not an asset. Equity is the contribution by the owner to run the business. So when the business gets $10, that means the business gets cash. So cash is now owned by the business, and the business has to pay back this $10 which the owner has contributed at any point of time when he wants to get out of the business. So that's why assets are those which are owned by the business. Liabilities are what the business borrows from the third parties, not from the owner. So that's why liabilities are different from that of equity. Equity is the owner's stake in the business. So these are the basic three O's which we need to understand, which is the fundamental of an accounting equation. Assets are owned by the business. Liabilities are the ones that the business borrows or the business owes to the third parties, and equity is what is left over after the third party liabilities are met from the assets. So these are the basic three important definitions in the accounting equation. Assets should always be equal to the total of liabilities and equity. Assets are equal to the total of liabilities and equity. So that is how it is balanced. Assets are equal to liabilities plus equity. Okay, coming to uh, the next step in the business is what happens when the business starts moving. The business starts moving, that means the business will uh, let us say borrow $20 from the business will borrow $20 from the uh, okay, so the business will, let us say, okay, now you see that the business has borrowed $20 from the third parties to buy a building, right? So business has borrowed $20 from third parties. So you can see there is a change in the composition of assets, liabilities, and equity. Equity remains same because the $10 which the owner has contributed, it has not changed. Whereas cash is not changed because there is no transaction. Only change is the liabilities where the business has incurred $20. For what purpose? To buy a building. So now the total of assets, as you see, cash is $10, business is 20, building is $20. So it is total $30. And liabilities $20, which the business has borrowed, and equity is $10. So 20 plus 10, $30 is the total of liabilities plus equity, and assets are 10 plus 20, which is 30. So always remember that the total of assets are equal to the total of liabilities and equities. These are basic accounting equation which we need to remember. Now coming to uh, more discussion as to what is an asset. It's explained, or what are the composition of assets. So we discussed that assets are owned by the business, liabilities are those that the business owes to the third parties, and owner's equity is what the owner has invested in the business. So assets are owned, liabilities are owed, and owner's equity is the investment in the business. And you can see, for example, there examples are given: assets, cash. Cash is a real tangible asset. Tangible means you can feel it. Inventory, when we buy from someone, or the inventory can be any product. For example, you are dealing in a car manufacturing unit. So the inventory would be raw materials or finished goods or work in process where the car is in the assembly line. So inventory. So those are the merchandise inventory, which is part of the asset. Receivables, what is a receivable? When you sell on credit, you have to get that money from the buyers. So the credit sales are called receivables, which you have to receive. So that is an asset. Prepaid expenses or examples can be rent. You make 6 months advance payment or 3 months advance payment, and you buy an insurance policy. So those are prepaid expenses. Why we call it as prepaid means these expenses are not incurred today. It will be incurred over a period of time. So the expenses for which we paid today, it is prepaid. That's why it is part of the assets. Similarly, equipment is furniture, machinery, computers, building, lands, and so on. So those are part of the property, plant, and equipment, are classified under assets. Coming to liabilities, accounts payable. We buy inventory and we promise them to pay after a certain period. So the amount that we owe to the third parties is called accounts payable. Or maybe expenses which we have not paid today, salaries and wages, we are going to pay after a month. Similarly, we are going to pay the electricity or utility bills or telephone bills, which we'll be paying after a certain period. These are accounts which are payable, the dues which are payable. Taxes payable is part of it. Liability. Notes payable, when you borrow from a bank, when you execute a promissory note, you will be uh, you will be promising them to make the payment after a certain period. So that's why it's called notes payable. That's a liability. Depending on the duration, it can be short-term liability or a long-term liability, which we'll be discussing moving forward. Coming to deferred revenue. What is deferred revenue? All of us know is income. But here we are calling it as a liability and classifying it as a deferred revenue. That means the revenue which we are going to receive is deferred. For example, Apple iPhone 17 is going to be launched. Okay. And you have to make a pre-booking and you have to make some deposit. So when Apple company receives from lakhs of customers, millions of customers, so those amounts are actually liabilities for Apple Inc. Because as long as they are not able to deliver those iPhones, the amount that has been received in advance is not classified as an income. So once they ship those iPhones, once they deliver those iPhones, then only it will be classified as an income. Till that period, it is a deferred revenue. In case they are not able to do that, they have to refund that amount. That is why it is classified under liabilities. So assets, liabilities. Then equity. What is equity? What owner has invested. Example, owner's contribution. Owner's contribution is by way of share capital, or the revenues which the business generates is added to the owner's contribution. The expenses are subtracted. Revenues and expenses can be examples of revenues or sales, interest income received, rental income received, service fees received, all those are revenues, income for the business. Similarly, expenses you can see are wages, cost of goods sold, or cost of the merchandise, rent, depreciation, and so on. So expenses, revenues minus expenses is profit. So naturally, the profit is added to equity. So always when we discuss on an accounting equation, please remember that assets on the left side, the total of the assets should be equal to the total of liabilities and owner's equity on the right side. So normally assets have debit balances, liabilities and equities have credit balances. More of these debits and credits we'll be discussing in my next video. Okay, and we will also do exercise on the basic accounting equation by working on the real life situation by taking a few examples and how we will plug in a table where we have assets on the left side, we have liabilities plus equity, how the accounting equation gets balanced. At any point of time, the total of assets should match with the total of liabilities and owner's equity. And we'll also have some exercises when or some case studies where we will find out what is the total of liabilities or what is the total of owner's equity when assets are given and one of either liabilities is missing or equity is missing, how to arrive at that number. Okay, going forward we will be doing that as well. Right, now you can see a real life example of a balance sheet which we discussed so far. On the asset side we have cash, we have inventory, and we have factory building and so on. These are basically assets. On the liability side we have loans, taxes payable, salaries payable, and accounts payable. And on the shareholders equity side we have the owner's contribution plus retained earnings. Retained earnings are nothing but profits made out of the business where the revenue exceeds the expenses, where revenues minus expenses is profit. Profit is retained in the business and it is added back to the shareholders equity to increase it over a period of time. So the basic accounting equation is assets are equal to liabilities plus equity. Right, now see an example of a balance sheet here. Right, we're able to see the balance sheet. Yeah, assets we have 150, liabilities we have 150. On the asset side it's not 100, it's actually 150. There is a typo, please overlook that. The total of assets should be 150, which is equal to the liabilities of $90 plus $60, which is $150. So $150, that is the total. Right, so we have some current assets, current liabilities, and then we have long-term liabilities, we have non-current assets on the asset side. All of this we'll be discussing going forward in a separate video as to what is a current asset, what is a current liability, what is a non-current asset, and what is long-term liabilities, etc., when we move forward in a new video. Friends, hope you understood this basic equation, accounting equation. Just to repeat, assets always should be matching with the total of liabilities and equity. So always remember, total of assets should be equal to the total of liabilities plus equity. Okay, so just to sum up what we discussed, assets are those which are owned by the business, liabilities are those which the business owes to third parties, which the business has to pay to the third parties, and equity is the owner's stake in the business. It is the stake of the owner in the business and it's a going concern. So always the owner will keep the money in the business to keep it running, keep it going. So when we borrow from someone, and the borrowings will result either in increase of the assets or in repayment of the liabilities, which we'll be discussing going forward by taking a few examples. Friends, hope you understood this basic concept of the basic accounting equation. Assets are equal to liabilities plus equity. Thank you, friends. Thanks for your time. Thanks for watching. Have a wonderful day. Bye bye. See you in the next video where we'll be working on a real life example as to how we will plug in the amounts in the accounting equation table. Until then, bye bye. Take care.